So Sam, thanks for joining us tonight. Tonight I bring one of the mortgage financing companies I work with, CMLS Financial. They're a leading mortgage financing company. And they're really creative when it comes to finding solutions to helping people buy properties, and also offer a very competitive mortgage product when it comes to like prepayment privileges, turnaround times, one of the fastest in the industry. I get approvals within 4 to 6 business hours versus waiting 2 to 3 days with the big banks. And Michelle is extremely knowledgeable. Her background, she'll probably be sharing in a moment, um, with regards to how long she's been in the business, and her knowledge about the mortgage industry in Canada is superior to a lot of people I work with. So, Michelle, the floor is yours, and look forward to hearing your updates with regards to today's market.
Thank you, Carmelo and Alex, for having me tonight. It's always a pleasure to join you and talk about the mortgage market, talk about CMLS Financial, and I really do enjoy talking about mortgages, as you know. So a little bit about me. I've been in the mortgage industry for, I think we're coming up to 25 years. I always forget if it's 22 or 23, and then I realize that I've been saying the same thing for about 4 or 5 years. So a couple of years in the industry. I've done a lot of different types of roles too. I've been a default insurance lender. I've been an A lender, B lender, and I'm back to being A lender again, which is the prime market. And when it comes to mortgages in Canada, it's really interesting to know who you're borrowing from. Most people think of the banks first, but at CMLS Financial, we're not a bank. We're a mortgage finance company. So who is CMLS? We're a lender. We've been in Canada for over 40 years. I think we're actually getting closer to 50 years at this point, back to how time passes and you forget how quickly things happen. But we're one of the largest independent mortgage companies. So that means we're not a bank. We're not publicly traded either. And we do commercial lending. We do residential lending. We have some private arms as well, but we also do a lot of mortgage servicing. So for some other established institutions within Canada, we help them service their mortgages as well. And just a little bit about what a mortgage finance company is versus a bank. Well, we only do mortgages. So we have one line of business, and that's why we're able to be experts in what we do, as opposed to a bank that does a lot of different things. They've got credit cards and savings accounts and such. So you've got a lot of people there who know a little bit about a lot of things. Well, we just know a lot about one thing, and that thing is mortgages. So what I really want to talk about, what really gets me excited, is talking about the market, because the market's been up and down, and over the last couple of years with interest rates, it's been very interesting to see how things have grown and how they've slowed down a little bit here and there. If you're asking me whether this is a good time to buy, I will always tell you that this is a good time to buy, especially if you're buying to live in it. When you're buying to speculate, if you're buying for investment purposes, it's always going to be a little bit more risky because there's other environmental factors. But one thing I do know for sure is real estate has outperformed just about every other investment out there. People who bought properties, even though there might have been a couple of tough years being a landlord when, during the pandemic, some people had trouble paying their rent. So there were some stressed out people who had to make their own mortgage payments when they weren't getting paid. It's still been one of the most performing investments in the last, I think it's 20 years was the last stat that I saw. So if you're getting into the market for any reason, it's a good time to buy. Now, I've been putting these numbers on this chart, this particular chart, in fact, for almost 10 years now. In 2016, I started just paying attention to the numbers a bit more, but it was really in 2017 that everyone thought that the sky was falling because the stress test had been introduced. And so I started just looking at patterns. Like, this is what the mortgage market does. This is how, people buy at this time of the year and they don't buy as much at this time of the year. And then the pandemic happened and my chart looks like, I don't know, the Milky Way, really. It could just be stars up in the sky at this point. These lines don't really make as much sense as they used to. Because once upon a time, I think the last time we had what I would consider a normal market might actually have been 2016. That's this red line right here, where, excuse me, we would start out the year a bit slower. It's January. We're getting over the holidays. It's cold. People don't really want to be outside shopping for homes. So it was a slower start. But, maybe they're getting a little bit of the itch in February. By March, they're anxious to get outside. And maybe they really want to get a backyard this year. So people start shopping in earnest. And that's where the spring market was born. And so, April, May, June, off to the races. We were selling houses like crazy. And then it would slow down a bit in the summer as we went on vacation, pick up a bit in the fall, and then slow down again at the end of the year. That was the normal market. Well, we haven't quite seen that in the last few years, but we are still seeing signs that it picks up a bit in the spring, slows down in the summer. So that curve still does get followed. What I think is really interesting about our market is that once upon a time, we were up here at just under 16,000 sales in 1 month. And now we're under the 6,000 mark. And we haven't, now this was outside of everything. You notice that's very much outside the norm when we were up in 16,000 sales in March of 2022. But, sorry, actually that was 2021. We're probably not going to hit that kind of frenzy in the next couple of years. Real estate has slowed down, but we've also seen the rates have gone up, which has slowed down some of the buying. Now, we've got a lot of people talking about how rates are supposed to start coming down. I think more or less all the economists agree that we're not going to see rates go up any further right now. Maybe we've peaked, but nobody seems to know when they're going to start coming down. And I believe that once those rates do start to come down, we are going to see the number of sales pick up exponentially.
Is this TREB or this is Ontario or?
This is TREB. Sorry, the intro screen showed that it was Toronto Real Estate numbers. So TREB is GTA, right? And GTA is everything to the Greater Golden Horseshoe now. And so these numbers would be, downtown Toronto, but they would also represent, getting into Niagara, Stony Creek. We're talking about Woodbridge. So really representative of all of the GTA. Not all across Canada, because if we were looking at Canada, we would see very different patterns. I think would be the same in terms of numbers. Where you would see the bigger difference is the next slide, which is prices.
Okay.
Yeah, but we're going to talk about those in a minute. But what I think is more interesting is we're right down here right now. We're just under 6,000 sales in February. March, anecdotally, and Alex, I'm sure you could weigh in and what you've been hearing a little bit more is how are we doing? Are we picking up or are we slowing down again?
Well, it seems like, first of all, there's a lot of pent up demand. So that point that you made about what's going to happen when interest rates start to come down, I just think it's going to become a mess. Like everybody's going to come to market all at the same time. And, like different property types have been performing differently, especially in the last year. So like we do have pockets in the GTA, especially parts of York region. If you go to places like Richmond Hill or Vaughan, where we always had lots of demand. There was always multiple offers. There was, properties were always selling, like maybe not at peak prices, but near them. But then we also have different property categories, things like condos that have been kind of lagging behind. But as we see that there is, a kind of a growing gap in price between detached properties or just freehold properties altogether and condos, I think that people are going to be now turning more to the affordable options, especially those that are kind of just like looking to, get that first foot in the door and get their first property. And that's what it like, it's all about kind of like getting into the market with a property that you are comfortable supporting. And then you have just so many options that open up to you. But this year, I mean, I see, again, it's property types, but I do see that there are a lot of buyers out there shopping, looking for properties. I don't know if they're all actively like submitting offers on properties, but they're getting prepared. And maybe Carmela, you can talk about the amount of pre-approvals that you're doing. If you want to unmute yourself.
Again, I'm doing a bunch of pre-approvals, but the people I've been working with over the past few months, or I noticed just in the last few weeks, they've actually made offers and have accepted offers. They know rates are going to be coming down, and the interest rates have come down since the October peak, and they're more comfortable with today's rate environment, knowing that, okay, I'm getting a property now at a lower price versus waiting for rates to go down even further. Once rates go down even further, the demand will pick up, and supply and demand is what dictates the price.
I 100% agree.
Yeah, so I think they're just more comfortable.
They're comfortable with the current rate environment where they took the plunge knowing that they're getting a good price. The amount of interest you pay on a mortgage is always based on the amount of money you owe.
Well, and the thing is too, like you said that as soon as those rates start to come down, everyone's going to flood back to that market. So I think we will see this number come up from here. You know, obviously it's going to rise from here. It's very slow in February, but already in March, I'm seeing a ton more pre-approvals come through. I'm seeing a lot more purchases come through as well, which makes me very happy and very positive about the market. Because while the market's slow, that keeps the prices down. There's less competition in there. And if you can afford to buy now for sure, because again, everyone's coming. They're waiting, they've been saving their pennies. And this next slide, this is average sale price. Now, like the last slide, this is all of GTA. And this is all property types. So think about, we're talking condos, 2 single family detached, townhouses in here as well. And look at this big gap in the middle here. At one point we were sitting, you know, just under the $1 million mark, and then we made the jump. We're not going to go down below that. The average sale price we have to think is going to be around the $1 million mark. But again, all property types. Doesn't mean we're not finding really well-priced condos, especially if you want to leave the core. If you're prepared to go a little bit further out, we used to call it drive till you qualify. You will find a property that you can buy. And like you said, you just need to maybe check your expectations a little bit, right? Maybe you have to look at a different property type, Alex just said. We used to talk about the property ladder. We don't talk about that anymore. And like a ladder, you were climbing up, and every rung you were getting a little bit better. And so maybe you start with that condo, but that gets your foot in the door. It's not easy to save money, but it's a lot easier to build equity, especially in a really competitive market like the one we have here in the GTA. So once you're in, you're in. And then you can keep on building on that, because these prices do keep going up. Like when you hear that, oh, prices have come down. We came down from a very inflated area where people were throwing money at properties because if I didn't get a property now, I was never going to get one. That FOMO was very real for a while. And, you know, we saw it come down a little bit, but we didn't lose value. We normalized. So it's going to take a big event to see us come down. And I don't think any of us want that sort of event to happen, whatever that might be. We see when world events happen, you know, our economy shifts and things, but it will take an awful lot to see prices in the GTA decrease because the demand is always here. So I don't think we should be sitting on the sidelines, because I think our market is very strong. And as I said, I think it's a really good investment. In real estate is a very good investment, that is. But how can you afford it? I think that's a bigger thing, is everyone thinks, will I ever be able to buy a house? You know, you hear about, everyone picks on the millennials, don't they? Oh, millennials, I'll never own. Not true. It just means that you may have to borrow from mom and dad. You might need a little help, but all you need is that little boost to get in the door. And so what I have here is, I went looking on MLS today and I said, okay, let me find a condo. Maybe it's a 1-bed, 1-bath. So fine. It's a property. Again, gets you in that door, starts building your equity. So 1, 2, and 3 scenarios. This is the minimum down payment, which we always think of as 5%, but it's 5% of the first 500,000, 10% of any portion thereafter, up to $1 million, because these are insurable rates that I'm usually talking about. But this here is 5.7% down payment, 33 grand is your down payment on a $584,000 property. I'm not saying it's easy to save $33,000, but I know people who have $33,000 on a credit card, so it's easy to spend $33,000. But think about this. Your property could go up $33,000 in a year, but you're not saving that money in a year. So really think about the down payments and what is required. Now, this is the minimum down payment. So you will be paying a default insurance premium on that. People know it as a CMHC premium, perhaps. Anytime you put down less than 20% of the price of the property, you have to pay this insurance premium. And it protects whoever's lending you the money against the possibility of you not paying them back. But I put 3 scenarios here because a lot of people think, I need to put 20% down, so I don't want to pay for that. And I think that when you look at what it's going to cost you to save up the money, to save money on a premium, that cost is a lot bigger than what the premium is going to be. So $116,000 helps you avoid paying a $22,000 premium.
I noticed that in your in scenario 3, there's still a mortgage insurance amount though, $11,000.
And you know what? That's a really good point. I didn't cancel that out because you don't have to pay a premium in that case. So that
Right.
would actually bring that monthly payment down a little bit.
Nice. And then just the ability to leverage that asset, and like you're gaining. We've shown this before when we did presentations about ownership versus renting and the long-term costs of renting and putting money into somebody else's pocket instead of building your equity. Like when you're able to leverage, your asset, and like essentially like if the average property appreciates between, I don't know, Carmelo, like what do we say? It's like about 5 to 10%, or
I think it
conservatively
was like
5%.
around 7 to 8 over the last 20 years.
Okay, so 7 to 8 on like a $580,000 property. So essentially, like that appreciation is like having a second full-time job.
Yeah.
Yeah.
So 8% would be 46 grand, and that's basically what you're trying to save up there at 33,000.
Yeah. So
Think about that though. Saving 33,000 versus saving 116,000. So yeah, the more you put down, the lower your payment's going to be. Rates are all going to be, I put this on a 5-year.
And the
This actually would be a
amortization,
little bit higher. Sorry, go ahead, Sam.
yeah,
sorry, I muted that. Maybe we can address questions at the end.
Yes.
Oh, okay. So I actually did make another mistake on here. Scenario 3, I made 2 mistakes, Alex. I didn't take the premium out, but the rate's a slight bit higher at 80%. And this is a really funny one to explain to people, because if you put less money down, you get a lower rate than if you invest more into the value of your property. But
Why
it
is
is a reality that over 80% is the lowest rate, and under 65 is an equal rate. So that it's always the same, up to 65 or high ratio is what they call it. Because between 65 and 80% of the value of the property, when that's what your mortgage is, that's where the highest amount of defaults occur. So the most likely to not pay happens right in that category in the middle there. Because once you've put in 35%, you're so heavily invested, you could refinance out of that very easily. You're not likely to default. And when you're right at 80%, you've saved up every penny you have in this 116,000. So one thing goes wrong, you might not be able to pay your mortgage payment. So when you look at a scenario where I keep saying it's hard to save 116 grand, and it really is, well, you're also not leaving much gas in the tank at that point. So you're running on fumes, and you don't know if you're going to make it to the next service station. So I think that, a lot of times you really do need to look at it from the point of view of, how can I safely get in here? What's my comfort level at this? Do I want to put every penny in? Or might it be okay that I pay this money here? Because this $22,000, which sounds like an awful lot of money, that gets added to the mortgage, and that gets amortized over the life of the mortgage. So you're not paying it out of pocket. Yes, it'll up this amount every month, a smidge, but it's getting you in the door faster. And then to your point, oh, sorry, go ahead, Carmelo.
Again, it's not just to get you in the door faster. It's like, one, to get you to the door faster, but two, it's return on investment. If you're investing 33,000, and let's just say 5 years later that the property appreciates, let's just say $50,000, you got over 100% return on your investment.
Absolutely. And you've had a great place to live that you can paint any color you want.
You don't have to worry.
Change that bathroom.
You own it. Again, you own it. You're paying principal down. You have to worry about a landlord telling you what you can or cannot do. You have a lot more freedom. So it creates a lot of. But the biggest mistake I made in my life was not buying when I had 5% down payment. I waited till 20 and prices went so much higher. I would have saved so much money if I just bought it early.
I agree with you, Carmelo. It's like hindsight's 2020. When I look back at it, and actually, like, I don't know. I remember when I used to think that, like, if I want, like, I remember when I was 20 and condos were like $100,000 at like in North York, and I thought that, like, if you want to buy that, you actually have to like show up with $100,000 to buy it. Like I didn't even understand that concept, right? And then had I known that you could have bought with just 5% down, it's yeah. I see that the term here is 25 years. I've heard of some lenders. I don't know. Is that sometimes isn't there 30-year amortization, or is that not for this type of mortgage?
20% down payment minimum to get a
Okay.
30-year amortization.
So for scenario 3, essentially, if somebody wanted to do 20% down, but then do 30-year amortization, their monthly payment would come down even more, right?
Well, we'd be talking about different rates though, because
It would
this
be a
is an
different rate,
insurable
okay.
rate, and at 30-year amortization, you're in an uninsured rate or a conventional rate. And at that point, you're probably looking not at the 499 rate, but low fives in some cases on some specials. I'd say 5.5 is probably average.
Okay.
So a little bit more on the rate goes up a little bit too, but with the higher amortization, it takes the payment down a wee bit.
Right. Understand. So it's kind of just like looking at the scenarios, making sure that, I guess, like you're getting what you're comfortable with. You're not overextending yourself to the max. You have to, you want to have some kind of, breathing room there. But also kind of like, yeah, thanks for breaking this down. Like this really kind of shows and puts it into perspective, the different payment types and how they change with the down payment.
It's really important to sit down and talk to a professional about this. And when I started, everyone thinks, oh, I'll go to the bank and talk about this. Remember at the bank, it'd be like, and banks do a lot of things really well, but I look at it from a point of view of, if you went to, you went to the mall and you walked into any store and you said, hey, I really want to buy a new pair of shoes. And the person says, well, it's only my second day. I don't know anything about running shoes. Well, it's probably not going to be your best buying experience that you've ever had. And I think that in a lot of institutions, they have a lot of turnover. Whereas when you go to see a mortgage professional, it's so important that when you go see a broker or an agent, that's what they do. This is my profession. It's not just a part of what I do. So you want to get the best advice possible because you want someone to break all of this down for you. And if you just get someone who plugs a few numbers into a calculator, you're going to get a scenario 3 that's got 3 errors in it, as mine does, because I am not a mortgage professional. I am a lender, but I will look at, what Carmelo has found to be the best solution for that particular client and then help him find the best loan for it, as opposed to giving you your best options. So it's really important to go to the right people.
Thanks, Michelle. I actually do this with every buyer presentation with application before I submit to a lender. I go over the scenarios, break down different rates, different payments, so you know your options and you're making the most informed decision. It's not about the lowest rate. It's about getting the right mortgage that fits your needs and your goals. If you're going to sell your home in 3 years, why are you taking a 5-year fix?
I think that we've all learned at some point in our lives that buying the cheapest thing is probably not the best idea, because then it breaks in one day and you have to go buy another one, and you would have been better off to buy the better quality one in the first place, right? So it's the same thing. Always going for the lowest is probably not going to get you the best thing. So you need the good advice on it. Now, why do we keep saying buy a house? Why couldn't you just rent forever? So these numbers are going to change a lot, and they change pretty regularly. So this one is urbanation. This is supposedly GTA, but this one doesn't tell me what size. It's all property types, but so I'm not looking at a 1-bedroom, 2-bedroom, 3-bedroom. But I would think $2,100 is pretty low for GTA rents as an average, even at the end of December, even though Alex had just told me that rents had come down, because this chart just shows how much they fluctuate. This one I think is a little bit more representative because it's the provincial overview, and it tells you, a studio, 1-bedroom, 2-bedroom, 3-bedroom, what you're looking at, and across the country. It's not cheap to rent. If you're looking for a 3-bedroom, you're already paying $3,000 a month. And even in my most expensive scenario, you're at $3,300. Now, this is a 1-bedroom, mind you, but it's not going to get a lot cheaper to rent, I don't believe. Because again, you're not going to ever be in control of your situation if you're renting. You might be looking for a new place tomorrow if your landlord decides to sell. There's so many different variables as a renter. So I think that renting is a great way to put a great roof over your head. But as an owner, you're going to be paying yourself as opposed to paying your landlord. And you have that stability. And then you also have that savings.
Yeah. There's going to continue to be more demand on this as we continue to have more people immigrating into Canada, especially into the GTA. So just like as much as there is a little bit of a drop in rental prices now compared to where they were, maybe 6 months ago. But that's like, there's always like some fluctuation. Things go up and down. But when you look at it like at a big level, you can just see that it's pretty much just like a straight arrow going up.
Absolutely. So I didn't want to talk too much because I know that we tend to go, well, I think we could probably talk for hours about the market and mortgages, but it tends to get a little bit heavy for people who don't do this for a living. So I think we potentially open it up for discussion now.